Welcome back to e-learning course 0, Basics of Finance, session 2.2. In this session, we will talk about the term structure of interest rate, which shows the relationship between short and long-term interest rates. Learning goals of session 2.2 are to understand the term structure of interest rates and to derive it using zero-coupon bonds. Moreover, we will talk about the expectations hypothesis, which is one theory that provides insights what we can infer from the slope of the yield curve in terms of future interest rates. The relationship between short and long-term interest rates is called the term structure of interest rates. It depicts the relationship between the maturities of zero-coupon bonds and the corresponding yields. One insight we can gain from this graph is that yields change with maturity. The rates depicted in the yield curve are also called spot rates. For instance, the annual yield for a 20-year bond was about 2.6% in the beginning of 2018. The yield curve is derived from zero-coupon bonds or stripped bonds. This means we can think of the spot rate, RT, as the interest rate that makes a single payment at time t and pays no coupon. For example, in November 2014, a 10-year principal strip cost $789.63. In return, investors obtain a single payment of $1,000 in November 2024. In other words, investors pay $0.78963 to obtain $1 after 10 years. This can be rewritten mathematically in terms of a 10-year discount factor. Solving this equation for R implies the yield to maturity for a 10-year zero-coupon bond corresponds to 2.39%. Next, we have to understand the shape of the term structure. In this example, the current term structure of interest rates in the United States is upward sloping, meaning long-term rates exceed short-term rates. The question to ask now is why not everybody in the economy is holding long-term bonds? When we think about this question more carefully, three reasons seem plausible. One reason is simply that investors believe that short-term interest rates will be higher in the future, and it is reasonable to hold short-term bonds which can be rolled over in the future into short-term bonds offering higher interest rates. Another reason might be that investors worry about the greater exposure of long-term bonds to changes in interest rates. A third reason that seems plausible is the risk of higher future inflation, which would imply a loss in purchasing power, since coupon payments are paid in nominal terms. The expectation theory is one possible theory that explains the term structure of interest rates. The basic implication of this approach is that the yield on a long maturity bond is the average of the expected yield on shorter maturity bonds. Consider now a 1- and 2-year bond where the yield on the 1-year bond is 4% and you expect the yield on a 1-year bond 1 year from now to be 6%. If you buy two 1-year bonds after each other, your yield over the 2-year period is approximately 10%. Under the expectations hypothesis, where 1- and 2-year bonds are assumed to perfect substitutes, the yield on the 2-year bond has to be the same. It follows that the annual yield of the 2-year bond is about 5%. Note that under the expectations theory, investors are risk neutral. If investors expect future short yields to rise, it follows that the demand for long-term bonds will decrease due to lower expected profitability. This drives down the bond price, and we've learned that a lower bond price implies a higher yield. The result is an upward sloping yield curve. Now let's have a look at the data and see if we recognize a pattern that is consistent with the expectation theory. Note, this is not a rigorous econometric analysis to test the expectations theory formally. It is simply based on comparing the development of long and short-term rates. The blue line shows the development of the yield of 10-year government bonds, while the red line shows a short-term interest rate measured by the 3-month LIBOR. One fact we recognize is that long and short-term rates tend to move together. If current short-term rates are low and people expect them to be low, then long-term yields tend to be low as well. Moreover, the slope of the yield curve can also tell us something about the state of the economy. There is a literature that shows that a flattening yield curve might be an indication for an upcoming recession. The reason for this claim is that if investors think that the economy is going into recession in the near future, they expect that the central bank will lower the policy rate. This means short-term rates will fall and investors buy long-term bonds to lock in a higher interest rate. This means the demand for long-term bonds rises, which implies an increase in bond prices and a decrease in long-term yields. It follows that the yield curve will flatten. As mentioned before, the expectation theory of the term structure does not consider risk. However, we know that people in the economy care about risk. For instance, high inflation implies a loss in purchasing power. An upward-sloping yield curve might be an indicator that the higher yields of long-term bonds contain an inflation risk premium. The exposure to inflation risk can be reduced by investing short-term and rolling over the investment. If inflation risk is an important source of risk for the long-term investor, borrowers must offer some extra incentive if they want to lend long. After having carefully studied session 2.2, please start with the review questions.